What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and to learn how to think critically about the systems of power shaping our world. My guest in this episode of Hidden Forces is Andy Constan, the founder and proprietor of Damp Spring Advisors, who previously worked at Bridgewater Associates as an idea generator, more recently at Brevan Howard as chief strategist, and spent 17 years at Salomon Brothers, where he served as head of global equity derivatives. I asked Andy to come on the podcast today to help provide some context for a very big news week in markets that includes consumer and producer price inflation numbers, the Fed's interest rate decision, and the committee's summary of economic projections, as well as initial jobless claims, retail sales numbers, and much more. What Andy brings that is most unusual is a perspective that is quantitative and flows-based. He looks at not only what policymakers and investors are saying, but what they're doing, what they're buying, and how they're doing it. And this has important implications for the direction of bond prices, equities and other risk assets, inflation, and economic growth, all of which we discuss in the second part of today's conversation, where I also ask Andy about scenarios for the FOMC's rate decision and whether it's going to be seen as the long-anticipated pivot or yet another head fake toward higher for longer that's ultimately going to be a drag on equities and put further pressure on economic growth. If you want access to that part of the conversation and you're not already subscribed to Hidden Forces, you can join our premium feed and listen to the second part of today's episode by going to hiddenforces.io/subscribe. All of our content tiers give you access to our premium feed, which you can listen to on your mobile device using your favorite podcast app, just like you're listening to this episode right now. If you want to join in on the conversation and become a member of the Hidden Forces Genius community, which includes Q&A calls with guests, access to special research and analysis, in-person events, and dinners, you can also do that on our subscriber page. And if you still have questions, feel free to send an email to info@hiddenforces.io, and I or someone from our team will get right back to you. Lastly, because this conversation deals with investing, I want to make absolutely clear that nothing I say on this episode can or should be viewed as financial advice. All opinions expressed by me and my guest are solely our own opinions and should not be relied upon as the basis for financial decisions. And with that, please enjoy this excellent and timely conversation with my guest, Andy Constan. Andy Constan, welcome to Hidden Forces.
Oh, thanks a lot. I appreciate being on.
Yeah, it's great having you on. So Andy, you are a gray beard. This is your term. You and your co-host Nick have a show called Two Gray Beards. And I saw that you worked for 17 years at Salomon Brothers. You were also at Bridgewater. So I'm curious, maybe to begin with, for people that aren't familiar with you, I'd love to know your background and how you got to doing what you do today. And what is it exactly that you do? How would you describe that?
Sure. So again, as you said, I worked at Salomon Brothers in a few roles, all trading oriented. I was a convertible bond trader, then an equity derivatives trader, then an equity derivatives trader and manager. Then I took over sales and structuring and ran the global business for Salomon and its merger partners through 2003. I was always involved with the equity market, but obviously Salomon Brothers had a big fixed income business where long-term capital guys came from and a variety of other sort of big names in the fixed income world. And I started a hedge fund for relative value trading soon after that when I left Salomon with a bunch of fixed income traders from Salomon. That lasted about 4 years, and then our partnership unfortunately fell apart. And I tried to launch another fund basically in 2008, which was not the right time to start trying to raise money, as most people were not allocating. And then was on the sideline during the financial crisis and joined Bridgewater to round out my understanding of what matters in markets and learned from, I think, the best on the planet in terms of understanding macro. Did that for a little over 3 years, and then worked for Brevan Howard for 4 years. And learned a very different style of macro. And then Alan Howard, the CIO of Brevan Howard, asked me to go outside and still service him as a research provider or strategist And he helped me launch Damp Spring Advisors, which is its primary business is helping hedge fund managers understand what I've learned over the years in macro and portfolio management. And that has morphed into a fairly large presence on Twitter, where I interact with a lot of great minds who are trying to figure out what's going on in the world. And that's spurred a more public face, but the same basic approach, which is trying to understand macro, trying to understand what drives markets, and then what to do about it.
So I have another question. Actually, since you brought up Twitter, I'm curious. You said you interact with a lot of great minds. How useful is it as a marketing tool for getting your research out there versus how useful it actually is as a way of refining your understanding of markets as you sort of test it against other people's opinions?
Right. So the purpose for me to be on Twitter is to basically have high quality discourse with people who think differently than I do in the public square for the benefit of myself and hopefully the person I'm conversing with, and in public so that others can take from that conversation what they will. And that's the principal reason I'm on Twitter. It's been great. I've met some phenomenal people. That's the principal reason. I have a large wait list for my investment products, so I'm not really looking to market anything anymore. But initially, it did impact my ability to, it allowed me to meet hedge funds that I didn't have access to, and a whole bunch of fairly committed people who have also followed me into my product offerings for them, and including Two Gray Beards, which is the most recent product we've created.
Yeah, I actually recently subscribed to that product to listen to some of the videos before this conversation. Yeah. So the reason I was asking, at least the second part, about how useful it is as a tool for you, not a marketing tool, but a tool for refining your opinions, is because I feel like, in my experience, it's a kind of double-edged sword. I see a lot of investors or people who put out research who also end up getting sucked down all these conversations and feuds on Twitter. And it's and I feel like it's a double-edged sword because I don't know how useful that is, but I definitely know it's useful to be exposed to ideas and get to test your thoughts about that. So I have one more question about your background, your research specifically, which is, who is this research for? And who are your readers typically?
Right. So my experience at Bridgewater and my experience on everywhere else but Bridgewater has had the following difference. At Bridgewater, there are no economists. There are no portfolio managers. All that the team does is just does the whole gamut of understanding how the economy works and what to do about it in markets. There are no silos. My experience on Wall Street has been one of, and that includes my own hedge funds, that includes Brevin Howard, and many, many of the other funds I have as clients and who I have friends at. Economists are excellent at understanding the economy, and hobbyists when it comes, and this is a generalization, hobbyists when it comes to markets and what to do about that. So they may be excellent at plotting the central bank moves or analyzing the flow of quantitative easing or the plumbing of the banking system. But they don't know what's priced into markets and what the best way to express that view is. They can be right 80% of the time on their calls and not make money. And my experience with portfolio managers, and that includes Wall Street sell-side traders and prop traders on Wall Street back in the day, and certainly hedge fund traders, is they are excellent at the latter and hobbyists at understanding the way the economy works. And so my role at Brevin was because I had significant portfolio and trading experience, and this deep understanding of macro, was to provide the whole thing to the team there, both the economists, anybody who wanted to listen. And so I find that what I write tends to appeal to a wide range of audiences and is fairly unique in the space because of my breadth and depth of, it's just a fact. I've been doing this a long time. I've done it from both the strategist, economist sort of space, but also constantly connected to markets. And that's a fairly unique offering. So my hedge fund clients, I think the last I checked, has about I have about clients now, they probably don't listen to me at all for their process, who knows? But they have about $200 billion in assets under management in macro. And, they seem to value what I have to say. Other listeners, depends on the type of, my general Twitter feed. As you said, it's an ugly place sometimes there. Some people just want to know whether it's going to be a red day or a green day. And I try to appeal to them on occasion just for fun. But by and large, I try to have, high quality dialogue, and whoever consumes it in the way they do. So it depends on what I'm trying to offer and who the client is. But, they seem to like that holistic approach to both markets and macro.
Yeah, I was asking you before we turn on the microphone how you would describe the perspective you have, because it does seem to be very flows based. I've seen more of this type of analysis in the last, say, 10 years. It's not common, but I wonder if it's become more common because economic models have become less useful today, even less so than they typically are with every cycle. With every cycle, models become less representative and need to be updated, but are they less representative today on a relative basis? And has that made this kind of analysis more useful because it's very empirical? It's focused on what's actually happening, what's happening in the plumbing, as opposed to this theoretical construction of what the economy should be doing, how markets should be reacting to the data, et cetera. Is that a coherent question?
It sure is. I would phrase it differently. I would say that this is an arms race, and to participate in that arms race, you have to be both innovating and also perfecting things that are scaffolding your cutting edge stuff with very strong basic principles. It's not that understanding the way the economy has become less useful. It's still extraordinarily important and necessary to be successful. But at the same time, it's, table stakes. You can't even play the game unless you have the basics, and you have to have those basics in an extremely well thought out and rigorous way. And so you can't just show up with a flow idea, like a number of people on Twitter actually have lately, with a simple equation and think you can make money in markets. You have to have the whole ball of wax, and you have to constantly be improving your basics and advancing where you can. And it's a daunting process, and one that, as a sole practitioner, I'm way behind the best people out there. And they're investing thousands and thousands of man hours every year to stay ahead.
Well, I'm glad to hear that, because actually I do want to, hopefully in the second hour, have a chance to talk about your broader macroeconomic framework. Before we do that, today is an important week in the markets for data. You and I are recording this today on the morning of Tuesday, June 13th. We just got the CPI number. It basically came in at what the market was expecting. We have the FOMC meeting today and tomorrow, and then we have the press conference and the Fed hike decision. We have a revised or non-revised dot plot, et cetera. So I'd love to kind of get a high-level overview from you to understand what you think markets are looking at and what you're focused on and what you're expecting and looking for this week.
I think broadly, I've been fairly aggressive saying that the inflationary tailwind remains extremely strong and will require the Fed to be higher for longer. I've been saying that for, since the hikes began, really. And I would say nothing's changed in that view. The pricing has begun to accept that possibility, and it's come, I think, at the expense of those who are expecting a imminent recession. Stocks have rallied. That's consistent with higher nominal GDP. Bonds and the short end have sold off, and that's consistent with higher nominal GDP. Those are the opposite trades one would expect to have in a recession. So I think that's by and large what's happening and continues to happen. And, having had this view for almost a year now, at some point, an actual recession needs to happen for it's not desired, but it's essentially required to have a recession to make sure inflation is well and truly dead. And so I think that's the path. And now it's a question of how long is it going to be higher for longer? I think it's still going to be higher for longer and higher than markets anticipate. But at some point, markets will anticipate that or even potentially over anticipate that. And then, then the odds would say go for a recession.
So that raises a bunch of questions. I'll try to rattle them off together and try to focus in on one big one that comes out of that. So I guess the one that comes up to mind, of course, is like, why haven't we gotten a recession yet? Or why hasn't the data reflected that more clearly, given the very rapid rise in interest rates? That's, I think, a question that a lot of people have been asking, myself included. Another question that kind of comes in, and then again, we'll tackle all these, but I want to put them out here. Another one that comes to mind when you were talking is, well, how high can the Fed really raise interest rates before it becomes a real problem? And not just for the private sector, but also for the Treasury. And I get that the bond yield's inverted, but then that also raises the question of, well, why is the Treasury looking to fill the TGA with higher bill issuance? And that seems to be sort of at odds with the Fed's monetary policy. And so I guess those are the kind of the thoughts, the three kind of questions that came at me when you were talking, but feel free to take them each as you will or combine them however you like.
Yeah, I'd like to break them down because that's
sure
how I think, but gosh, that was all the things I'm thinking about. So you've hit a lot of very, very important concepts. I guess the first question that you asked, and I think it's the right place to start, is the Fed has done a lot, and that's had an impact. And the question is, has it had enough impact? And so I would say the answer to that is it really hasn't. And I would say the best way to describe that is that the current U.S. economy, as opposed to the 50s or 60s economy, is just, and this is an obvious point, is much more services oriented than the purchasing and construct and building of heavy things that if you drop, hurt your foot. And the reason, that has an impact on the way interest rate hikes impact the consumer, in that the way that the transmission mechanism for interest rate hikes is basically twofold in terms of what it does to the consumer. One, it discourages the use of cash for consumption, because cash earns a lot in your bank account or in T-bills or in money market funds. And so it pays to save, whereas it hadn't when interest rates were low. The other thing is it costs more to borrow. And so mortgages, for instance, are quite high. And so that discourages the purchase of capital goods, homes, automobiles, even factories at some level for corporations. But it doesn't really do much for services. In fact, there's some school of thought that certainly has some truth to it, that savers are now getting a lot of interest, and that interest is allowing them to consume. So basically what the point is that raising interest rates is not the economy is less responsive to change in interest rates. You can tell that because the economy was not particularly responsive to zero interest rates. When interest rates were zero, that did not encourage borrowing and consumption such that we had inflation. This is pre-COVID. And for 6 or 7 years, there was no inflation with zero interest rates. And so you would think there would be, but there wasn't. And so that responsiveness to interest rates is an important aspect. But, the Fed only has a couple of levers. And so they use what they have. And I'll come to the fiscal side in a moment, but the fiscal side is actually, you raised a narrow point on the potential for fiscal and monetary out of syncness. There's a even bigger point, which I'll get to, but they have two levers, basically. One lever is interest rates, and we said why that may not be as effective as it has been, and why they'll have to go higher for longer.
Can I interject with I don't want to throw you off, by the way, because I already give you a tough task of going through. So in comparing, like in 2008, did interest rates and tightening credit conditions play a bigger role because of all the adjustable rate mortgages and the role that housing played in the lead up to the 2008 crisis? Whereas today, a big part of where we are today is because of the fiscal stimulus and the credit guarantees by the government of bank loans. And so the interest rates haven't played as big of a role because they didn't play as big of a role in fueling the inflation to begin with. And because there is a sort of a higher, perhaps there are other supply side factors that are driving inflation as well. that are independent of monetary or fiscal policy?
Well, I would say that the 2007, 2008 situation was a credit crisis, and the ability to withstand a credit crisis does call for both fiscal and monetary stimulus, because money gets tight because people are defaulting, and the people who they are defaulting to then don't have money. And so that is a natural reason to lower interest rates, which they did. But they kept interest rates very low for a long time because there was a lack of significant fiscal stimulus during that period of time. And so I basically think the inflation that we're seeing now is due to fiscal stimulus, not the monetary conditions. And of course, boats stuck in the Pacific, COVID, factories closed down, all those sort of things. Those supply the war, all those supply disruptions were real, but those are mostly behind us. So there's inflation that's going on for other reasons that isn't supply chain related anymore, or at least by and large isn't. Now, we could have some volatility in supply chains, and I'll get to that too, because there's a big dynamic that is at play that can perpetuate inflation, and that's deglobalization. But anyway, so the point on this responsiveness has led to the Fed needing to do quantitative tightening. And they announced that in December of 2021, and the markets panicked. This was while QE was going on. We had the big sell-off in bonds and stocks through June of 2022 that we're now recovering from. And basically, during that period of time, the Fed has reduced its balance sheet by about $500 billion. They've also reduced its holding of mortgages during QT as well, but it's actually going a lot slower than they had planned. And so in aggregate, $500 billion of treasuries have now had to been absorbed by the market. And the front running of that supply, devastated the market in the first half of 2022. But since then, the Treasury had borrowed, prior to QT starting, the Treasury borrowed a lot of money and had their checking account, the Treasury General Account, at around $700 billion. And so that was, at the same time QT started, the TGA started consistently being spent.
For people that don't know, the TGA is the Treasury General Account. It's where the Treasury keeps the money that it gets from sales of U.S. Treasury securities.
Right. Also, it's their checking account, really. So things go into it and things come out of it. The things that go into it are the proceeds from issuance and your tax dollar. And the things that go out of it are maturities of bonds and bills and expenditures. And so during that period of time, the government infused $700 billion of spending into the economy, right as the Fed was withdrawing $500 billion of liquidity, for the sake of a better word, from the economy. And so if you look at the effects of quantitative tightening, they've really been, in a meaningful way, sterilized by this TGA drawdown, spending from the TGA. Now, in addition, the government over the last year has run roughly $1.2 trillion in deficit. So that money, and there's some double counting there, I won't get into the weeds with this, but that money also has stimulated the economy because public sector spending, deficit spending, is stimulative. People have deposits and they can then spend them or save them. And so that, to me, means the lever of quantitative tightening was front run heavily and now is really not doing much. So those are a couple of monetary reasons why, with a nod to some fiscal reasons why inflation hasn't been responsive. And it has been. It's down a lot, but it's still very high and too high for the health of our economy.
And to what degree is it down because of government policy, and how much was it going to decline anyway, right?
Yeah.
Because what you're saying is it's the liquidity outflows caused by QT have been more than offset by the spending that's come out of the Treasury.
Yeah. So that's a good question. And unfortunately, we'll never know the answer because they did what they did and we have what we have. And we don't know what would have happened if they hadn't done what they did. My guess is that certainly the supply chain resolution had a meaningful impact on the level of inflation over the course of the last year. I think that's played its course, but, it certainly had a meaningful impact. And now we have this situation where the labor market is very tight. And this is this deglobalization thing that I call the 3Ds. And the 3Ds are deglobalization, which means onshoring of productive facilities, domestic energy investment, so that we don't get those who are dependent on Russia, for instance, or an enemy, for instance, on their supply of energy, build alternatives, whether that's nuclear or renewables or domestic oil, or making deals with their local allies. And then there's duplicate supply chains where instead of sourcing from a potential enemy, you source from somebody close, like for the US, maybe it's Mexico. And each of those 3Ds needs to be invested in to create those three infrastructures. And that investment and the public sector is the one who funds that investment. And so the public sector spends for the chips factories that they're building, for instance. And that generates construction jobs, it generates food truck jobs, it generates babysitting jobs, it generates healthcare needs. All of these things, all these services flow through simply because the US and all of the world is investing in deglobalization projects. And so I think that's a very important inflationary impact. And then, of course, a tight labor market is the second one. And I think those two things. And then lastly, there's this very significant amount of savings that could be turned into consumption or investment at any point in time if the animal spirits strike one. And that needs to be withdrawn. And it's been, as I said, because of QT being relatively slow, that liquidity withdrawal has been very slow.
So we're kind of getting a little ahead of ourselves because there's some other questions I wanted to ask you, but I'll put a pause on those. So I'm curious how you look at this, because it sounds like maybe we look at this the same way, which is that I went to school at NYU in the early 2000s. I got a bachelor's degree in economics and political science, but my economics degree was like a neoliberal economic world where you had a primarily free market, free in quotations, but relatively free. You had a central bank whose role it was to ensure that there was sufficient money and credit in the economy, but not too much, because we had this notion of inflation being a monetary phenomenon. And then you had governments, and we didn't really talk about those because they weren't that important, right? But it feels like what we're moving into now is a period where there's going to be much more coordination between the fiscal and monetary authorities, and where the fiscal authorities play a bigger role in inflation or deflation. And so that could potentially put a long-term structural floor on inflation. Is that how you see it as we move from this world of efficiency to redundancy and resiliency, economically speaking?
Yeah, I mean, that's the point of the 3Ds for sure. You don't create wealth by duplicating a supply chain that isn't needed. You create safety. You create insurance. You don't create wealth. And so when you spend without wealth creation, that generally flows through to prices. I would say that the idea that fiscal didn't play a role, I've been listening to the Fed for a long time. And I remember back in 2008, 2009, Bernanke saying, we're doing our part, but you need to do yours.
But wasn't that always like in terms of like this Keynesian counter-cyclical framework, which is there's a recession, we want to prevent a sort of perpetuating spiral of deflation, so the government needs to step in, dig some ditches, employ some people, and get a restart.
Yeah, versus and I think they asked for that and didn't get it, and so you didn't have that inflationary. The recovery was tepid and took a long, long time when the only pull was, I look at the Fed as being not a director of the economy, but someone who leans against the economy when it's going too far in one direction or the other. And I think the fiscal side plays a much, much bigger role. And the Fed's told the fiscal side to do that, and the fiscal side didn't. So I think they realized that and didn't make that same mistake in COVID and then overdid it.
Yeah. I think what's also interesting now, though, is something that I didn't personally, 15 years ago, didn't see as a role for the fiscal authority were things like credit guarantees. And I wonder if we're going to see more directing of investment and pooling of capital and incentives used by the government to try and drive capital to particular areas of the economy, especially as we have more we move from this unipolar world to a multipolar world where more money is spent on defense, more concerns about energy supply chains and energy security. That's why I was bringing it up. And I think for me, from my perspective, looking at this and wondering about it on a very macro level, that seems to be a long-term inflationary driver. There's also, of course, the omnipresent forces of technology-driven deflation, which, those are two very powerful forces. Then you have demographics too. And, we had like Charles Goodharter on the show, I don't know what it was, like a year ago. And he's someone, for example, that takes the perspective of the demographics are actually going to be inflationary. And I know there's some people that take issue with that, but that his view, they're going to be inflationary because the government liabilities, these people are voters, they're going to exercise political pressure, and this is going to put upward pressure on prices. And it just seems like, this is a really big question for investors long term, which is, where do you want to be? Do you want to be exposed to an inflationary trend or a deflationary trend? I mean, feel free to comment on that, but I have many more questions for you.
Yeah. So all those things are possibilities, and I could see them going in the way they go. I tend to stay away from futurist type discussions and politics in general, and look to something that I can actually tangibly grasp. And that, to me, is consistent with a horizon of sort of less than a year that I use for thinking about investing. And why I say that is, when I think about beta investing, I want to be balanced to all possible outcomes, and I don't want to place any particular emphasis on outcomes that I may believe are going to happen, because it's fairly likely others believe that, and it's already reflected in pricing. And so unless I have alpha and can say, this is something I'm committed to being a change in the next, and by the way, there might be people that have alpha in terms of that thing, futurist, but I don't have it. So I tend not to bet on that stuff. I'm happy to talk about it, but I don't find it to be useful for investing.
No, that's a great point. Before I ask you about what your expectations are for the Fed, the outcome of the FOMC meeting and the implications of whatever decision they come to, and the press conference and the dot plot, I do have a question with respect to what you said, because when I was reading through your reports, that was sort of what I was trying to get at when I was asking you, how would you describe what you do? Because it feels very sort of practical in that sense. That may not be the right word to use, but there was something that confused me, which had to do with, and maybe this will be useful for people to listen to, maybe not, but it had to do with the decline in risk premium, the inversion of the yield curve. And it seemed that in one part of one of your reports, you described that as having been a contributor for a rise in equity prices, the decrease in long-term yields. And so what I don't understand, though, is at the same time, that inversion seems to be correlated with the impending onset of a recession, which lowers earnings and which drives equities down. And I'm curious, how do you square that? How do you think about that? And how would you explain to people how that's consistent?
Sure. So, you're talking about risk premium, which is sort of the central value I think I generate from my clients at this point.
Yeah. And maybe you can also explain for people what you mean when you say risk premiums or risk premia.
Yeah. So basically, I look at anything that has risk, and that could be a 1-month T-bill, or it could be a 30-year bond. It could be a meme stock. It could be crypto. It could be the S&P 500. In order for somebody to part with cash, which they can spend tomorrow and know they have it tomorrow at the value they have it today, plus maybe a tiny bit of interest, they need to be rewarded for taking on that change in price risk, because they may need the money tomorrow. And if they need the money tomorrow, if they buy an asset today, they have to sell it tomorrow, and they may experience a lower price. And so it's just like anything. we're surrounded in this world by gamblers, and, Vegas offers negative expected value, the lottery even more so, for taking on risk, and people do it. So it's not certain that there has to be a risk premium to assets, but, that's what most economic theory is based on. And one I believe, which is to buy an asset, you need better than 50-50 odds you're going to make money. And now, of course, there are lots of other things that go into that. The fact that somebody pays you a positive expected value when you part with cash is that you have to choose assets, and assets are affected by other things. So if you choose an equity today, you have a positive expected value for owning it. If you choose a 30-year bond today, you have a positive expected value for owning it, even if
nominally speaking.
Nominally speaking, yes, in excess of what you would earn for cash. And that's what the risk premium is, that a little bit of excess return you own for taking on risk. Now, the problem is people hear that and say, wait, equities have a positive expected value, bonds have a positive expected value. That doesn't make sense because bonds tend to go down when growth is strong and equities go up, and vice versa. So, it matters which one you choose. And of course it does, because other factors influence investments besides the fact that you have a positive expected value today when you buy an asset. So that's the concept. Every asset at this very moment has a positive expected value relative to cash. And many won't have a positive actual return because their returns have other factors that drive them. So, things go down. So now the question is, if one asset is in high demand, and so investors are bidding up that asset to get some other person to sell it, that means the expected return, the risk premium, is falling on that asset. So its expected return is falling. Well,
the more people want something, the lower the risk premium.
Right. And so then the question is, okay, well, if bonds get bid up, like quantitative easing puts a new buyer into the market to bid up the price of bonds. If bonds get bid up, what happens to equities? Well, what happens is the seller of the bond to the government says, I still want a positive, I'm still willing to risk my cash, and I want something with a positive expected return, but this bond no longer has it, so I'm going to buy some equities. And so that buyer of equities transfers some of the risk premium decline from bonds to a risk premium decline for equities. And then through time, risk premiums equal, so that every asset not only has a risk premium, but has an expected return, risk-adjusted expected return that's equal. If it wasn't equal across all assets, money would flow to the asset with the higher expected risk-adjusted return. And so I think that's how risk premium arbitrage across markets work. And so the concept that I described in that Damp Spring report was that for whatever reason, there has been a lesser impact of quantitative tightening, as we just described earlier. And there has been aggressive pricing by fixed income investors, expecting the Fed to cut rates extensively and for a recession to have been created. And you see that in, sentiment, you see that in pricing. But it's also generated a very low risk premium. Some estimate it to be negative, where people are paying willing to take a negative expected return on bonds just to buy bonds in case of a recession. And so that has translated into a higher multiple for equities because risk premiums contract, equity multiples rise. And now what's flowing around is a very low risk premium across all assets. Now, is that worthy of using your cash to buy these assets? I don't think so. And so by and large, I've been short assets for when this bid went crazy, really was when the first inflation print in November for October's inflation data came in cold, there was a major sell-off in yields, bid for bonds. And that's, along with weak QT flows, has generated very rich bonds and very rich equities.
So I have a question about QT since you bring it up, because it's something you write about as well. And it's something I thought about, but I've always, been looking for other people who are experts to kind of ask it to, which is how important is the aggregate size of the Fed's balance sheet versus the composition and duration of the assets that it holds? And what can we surmise about the path of inflation and growth based on what the Fed decides to do with that composition?
Sure. So that's an academic discussion, one that I take sides on, but still is open to debate, between what's called the stock, which is the size and composition of the balance sheet, and the flow schools of thought. The stock school of thought was popularized by Bernanke when he instituted QE, was that the size and composition of the balance sheet reflects bonds that are held by the Fed that the private sector doesn't have to hold. And the other school of thought is that the growth of the balance sheet or the shrinking of the balance sheet, that is what generates the change in risk premiums, in that when the Fed is buying bonds, assets get bid up. And when the runoff is a little bit more complicated, but when the Fed is reducing its balance sheet, more assets have to be absorbed by the private sector, and that results in asset pressures. I happen to believe in the flow school of thought, but there's smart people on both sides. The Bank of England countered Bernanke's statement with, I think, the best flow description, which is on their website. Certainly I recognize that the duration of the balance sheet matters. But let me take that away from the stock school to the flow school. It also is, to me, very important to think about what the flow is. Meaning, if the Fed is buying 30-year bonds, they're removing a much riskier asset from the private sector than if they're buying 2-year bonds. And vice versa. If the Treasury, to pay the Fed for the runoff of its balance sheet, which is the way QT is working, has to issue into the private sector, and they choose bills, which are low risk, versus choosing 10-year bonds, which are higher risk, they are changing the transmission. They're choosing the transmission of monetary policy. And I think that's been an active choice.
The reason that I asked also had to do with bringing us back to this conversation about Janet Yellen and the decision to issue more bills, because I don't think we actually got to that. So in the context of that framework around composition and duration, what explains the decision of the Treasury to favor bills, which are short-term, versus bonds in refilling the TGA?
Yeah, it's my most recent Damp Spring report to my clients was called "Why Bills, Janet?" It's perplexing. It's a curious decision. So let me just sort of lay out my thoughts. The first thing I think is that they've got a lot of issuance to do. They have a goal to increase the checking account by $600 billion. They have the Fed to pay back over the next 4 months of $240 billion. And they also have a deficit to fund that might be, call it $400-500 billion. So round numbers, we're talking about something like $1.3 trillion to issue to pay the Fed, build the TGA, and fund the deficit. That's a lot. So what's the easiest way to issue a lot? The easiest way to issue a lot is something that people want a lot of and is very low risk. So there's always demand, and that's T-bills. So I get that.
Is that another way of saying that they're concerned that if they were to rely primarily or more on bonds, that would be disruptive to the bond market, and that it would maybe cause a sudden rise in long-term bond yields?
Yeah, I mean, I think the consequences of that are the trade-offs, and I think there's an important one, and there's some logical reasons why they may make that trade-off. But let's just start with the fact that, $1 of bills is much easier to place in the market than $1 of 30-year bonds. And regardless, the size of the bills market is much, much deeper. So I get that. They got a lot to do. They got to do it fast. They're going to go bills. And there's trade-offs. The second thing is that, and this gets into the weeds in terms of liquidity, in March of 2021, the bank regulators decided to change a rule that was in place for a year. It's called the supplementary leverage ratio, the SLR. They had granted a 1-year exemption in which bank reserves and accompanying deposits, which were flooding into the banking system through the fiscal channel, could be ignored for calculating the supplemental leverage ratio, which is an important factor for bank profitability and for the desire to have deposits. And so they knew a lot of deposits were going to flood into the market, and they wanted to make it easy for banks to carry those deposits. And they decided to let that lapse in 2021, March 31st, 2021. From there, banks said to wholesale deposits that they could no longer be in the banking system. And that's very hard to do because, you can't move your deposit from Chase to Bank America. You have to move it outside the banking system. And there was no place to put it without bidding up asset prices. And then whoever you bought those assets from, they then had a deposit. So, it becomes a complicated thing. So to do that, the Fed opened its reverse repo facility, which RRP, which allowed the people to move their deposits to a variety of agents, in particular money market funds. And the money market fund could take that cash that they had just gotten from the banking system and hand it to the Fed, and the Fed would pay interest on it. And so essentially, the market for bank deposits moved from the banking system directly to the Fed, where the Fed paid the interest instead of the banking system paying the interest. And that eased the pressure and allowed the Fed to also control interest rates because it controlled the rate that money market fund got. And so that's the mechanics of what happened. And now there's a huge amount of money, $2.1 trillion in the RRP. And so what that wants is bills.
Because of regulatory requirements.
Money market funds, 2A7 funds, have to own government collateral, bill, or make investments in government securities or hold government collateral for their financing repos they do. And the investable assets they have to be 364 days or shorter. So that's bills. So they want bills, but they went to the RRP because bills rates were way below the RRP rate. And so they are very happy. Now, what's interesting is the interest that is paid to the money market fund is paid by the Fed and essentially reduces the amount of money that the Fed could hand the Treasury as income from its activities. And so essentially the taxpayer is paying that interest regardless of the fact that there's no bills issues. So that we're paying this high rate of interest. Right now, it's actually...
Just to clarify something for listeners, what you're saying is that that's demand that could go into buying U.S. government debt, but is instead being paid out through the Treasury and interest because of the on-RRP facility and the rate of interest relative to bills, to the yield that you can get on short-term government debt.
Right. So what they want to do is have the RRP move out of that into newly issued bills. And so that's why you issue bills. They can't buy 30-year bonds. They can only buy bills. So the most direct way to tap that liquidity, there's weedy stuff about repo, private sector repo that could also tap the RRP. But the most direct way to tap that money is by issuing bills. So that's two good reasons. They've got a lot of it and they want to tap the RRP. The rest of the reasons get more murky to me and confusing to me. And so I don't know the answer.
Well, the reason that, because you mentioned something there, and that's what I wanted to clarify. Tapping the RRP, so if deposits from the banking system were used to fund primarily new bill issuance, that would have a negative effect on liquidity, which would be contractionary and potentially aid the Fed in achieving its inflationary goals. Again, these are theoretical constructions here, but tapping money from the RRP doesn't do that, or it has a mitigative impact. And that was something that stuck out to me as a kind of example of this disconnect between the left hand and the right hand.
I totally get that. I think that's right, except I would make the shades of gray are important. So the RRP has virtually no impact on markets. If the bills are funded by the RRP, literally a money market fund says, okay, I'm going to move my cash from the Fed to the Treasury, and that's all I'm going to do. It's not going to impede my ability to do anything I normally do, because all I do is I take my cash and invest it. I don't create money. Now, let's talk about creating money. The issue you brought up is that if the RRP doesn't fund the new bill's issuance that's coming, or the new bond or bill issuance, both, any government issuance, there's only one other source for it, and that is the banking system. And whether for their own account or for their account of their clients, when a bank, or on behalf of its clients, let's say, a client buys a treasury bill or bond, they cash out their deposit. This is plumbing. The bank hands the bank reserve that was against that deposit to the Fed, and they get a bond, and the client gets a bond or a bill. So if they fail to tap the RRP and the banking system loses deposits, we heard all about it this March when bank runs occurred. And that was banks that were potentially insolvent having all their depositors run. The thing is, they didn't really run. They ran to JP Morgan. They didn't run out of the system. Now, some of them did, but, by and large, the deposit system stayed the same, while certain banks lost all their deposits. And that's what happens in a bank run when a bank is insolvent.
So the individual banks were impaired, but the system itself didn't really lose deposits, except for money that has gone out to money market funds and this sort of slow bank run that people have heard about.
Yeah, Jim Bianco likes to call it the bank walk, which I like a lot. So when in this case, the money that is leaving the banking system exits from the strongest banks, the weakest banks, but proportionally exits by and large. And it's a walk, not a run. So the question that one has to ask is, it used to be in this country and around the world that the banking system worked on a fractional reserve basis. And so a bank could only have a certain amount of assets as a multiple to the amount of bank reserves they had. So if the banking system, these are not the numbers, but let's just use a number. If the banking system was required, the maximum amount of assets they could have, loans, bonds, anything that they lent to where they were a lender, was 10x their reserves, a decline in their reserves would require a 10x decline in their assets if they were at their maximum. We don't have that system anymore. So, and reserves are actually very plentiful in the system. And we have this 2 trillion of pseudo reserves that's in the RRP that literally by a stroke of the pen could flood back into the banking system. And that would be, for instance, re-exempting reserves. You'd have to fiddle with some rates as well, but by and large, that could drain the RRP through a regulatory response. So we've got these plentiful reserves, but, prior to, it's still a concern for some market participants that the failure to tap the RRP will result in a falling of bank reserves. And whether it's actual or perceived importance of reserves for the banking system, there's allegedly an impact. I think it's minimal, no impact for RRP, and just this side of white, not gray, just a little bit darker of impact by reserves getting hit. What's big impact is coupons. When you ask the market to absorb issuance that is risky. That tends to have a meaningful impact. And that's not what the Treasury is doing. And so that's the important thing to me. They made this distinction of RRP versus tapping RRP versus bank reserves, very modest and marginal on what it actually will do to liquidity. But the thing that they did was they avoided issuing a significant amount of coupons. They issued mostly bills. And so the question is why? And I have a few ideas.
And because those flows would marginally impact long-term bond yields, that's one potential reason, if I'm understanding you correctly. And that's what you're talking about coupons. So I want to hear what those ideas are that you mentioned, Andy.
Sure.
And I also want to game out some possible scenarios with you as they pertain to the Fed's interest rate decision tomorrow, what markets are expecting, what you're expecting, the importance of the summary of economic projections, the so-called dot plot, and Jay Powell's statement at the press conference relative to the decision to hike 25 basis points or not, and what all that means for equities, for bonds, and for gold. Is it going to be seen as a pivot, or risk assets going to rip higher? How should investors think about all of that? For anyone who's new to the program, Hidden Forces is listener supported. We don't accept advertisers or commercial sponsors. The entire show is funded from top to bottom by listeners like you. If you want access to the second part of today's conversation with Andy, head over to hiddenforces.io/subscribe and sign up to one of our 3 content tiers. All subscribers gain access to our premium feed, which you can use to listen to the rest of today's conversation on your mobile device using your favorite podcast app, just like you're listening to this episode right now. Andy, stick around. We're going to move the rest of our conversation onto the premium feed.
Great.
If you want to listen in on the rest of today's conversation, head over to hiddenforces.io/subscribe and join our premium feed. If you want to join in on the conversation and become a member of the Hidden Forces Genius community, you can also do that through our subscriber page. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. You can follow me on Twitter at Kofinas, and you can email me at info@hiddenforces.io. As always, thanks for listening. We'll see you next time.